Hey, Samir, we haven't met before. I was wondering if you wanted to tell us a little bit about yourself.
Yeah, yeah,
So Samir and I actually know each other pretty well.
Oh, cool.
yeah. John and I go way back. Like the last several years, I've run a recruitment firm focused on quantitative finance, and I met John through those endeavors, if I may. Before that, I worked in tech. I was working at startups in Austin and Chicago, and somewhat technical roles. And before that, I was in grad school. It was operations research was my master's, and undergrad was in India where I grew up. It was in mechanical engineering. Um, I find kind of the world of kind of finance and math and CS is kind of fascinating. I'm not working directly in the field, and I'm a layer removed given what I do. But when I think about sort of the way I grew up, the stuff I used to do as a kid, the time in tech. A time in school, all of that was very sort of STEM focused, and so I kind of gravitated towards, I would say, all things STEM. Um, lately, right? We have I have a child who's 7, and so lately I've been thinking the last several years, like 7 years or so, I've been thinking a lot about education, and how sort of how kids are impacted by education. I think about the bar, the bar in education just seems so low. It's kind of disturbing almost. And I think a lot of families, parents, sort of like we've settled on the fact that this is about as good as it gets. And I often think about, like, what else can we do? Like, why does it have to be sort of so suboptimal, so poor, if I may? So that has been like on my mind a lot, the last few years as I'm raising a child. John and I end up talking sometimes about, with work and finance and such a little bit, but oftentimes about kids and education and parenting and, long-term impact on kids,
Yeah.
as a function of stuff you do now, stuff you invest in, etc.
Jonathan, do you have kids as well?
I do, yeah. I have two girls. I have a 6-year-old and a 9-year-old.
Oh, okay. Wow. Wow. Yeah. So you guys are right in the same age bracket.
Yeah.
Yeah. How about
I
Yeah.
have,
yourself?
I have three boys. They're a little bit older. I have 11, 14, and 16.
Oh,
Mm.
wow. Okay.
Okay. Yeah.
Uh, but I think we have in common, we're a very like education focused family also.
Mm.
I'd love to hear more. Like what is it that you're, I guess, disappointed in?
I guess I'm disappointed in how stodgy everything is. It's been done the same way for 20, 30 years, and it seems like nobody really wants to change. Not no, in quotes, right? Most people don't want to change. When I bring ideas to the table, they're met with defensiveness. They don't welcome back and forth. It doesn't seem like the education community, um, they see new ideas as a threat to the status quo, as opposed to, oh, that's interesting, let's consider that, which is what I'm used to, which is what you guys are used to, right? Imagine if there was no innovation happening in finance, right? Nobody would make any money. And education doesn't train kids to think independently. Like, a lot of education is about discipline, right? You have to be in line, you have to do this, and you have to do that. Are they really making kids think? um, that's sort of one set. The other set is the bar just seems low. You've got a child who's got the ability, and not just one child. I think lots of kids have abilities beyond what is usually presented to them at school. But school has this very old-fashioned way of, this is first grade, this is second grade, this is third grade, this is what you study in first grade. You add some numbers. It doesn't have to be like that. Life's not like that, is it? Life, it's something that's thrown at you, and then you
Right.
have to go figure it out. And I don't think we do a lot of that in sort of the traditional education systems. So I would say
Yeah.
that people are really disappointing, and the content just seems kind of, it doesn't seem challenging. I think, when I think about it.
Yeah. I think one thing that I've always found interesting is as kids grow up, every sort of like subsystem of their mind and their body just kind of develops at different rates.
Yeah.
So like I don't know any kid where they're all sort of like average in every single category of their development. It's all like very uneven.
Yeah.
You kind of end up somewhere that's on the curve, but so then with education, that we were saying earlier about it not being kind of responsive to kids. I
Yeah.
haven't noticed that. I mean, part of the problem, depending on the school, but I think part of the problem is institutions are kind of designed to serve the population,
Yeah.
as
Yeah.
opposed to the individual.
Yeah.
Uh, yeah. We've had some experience now because our kids are getting older, so they've been in school for a long time.
Yeah.
And, our thing is, you really have to find like a school that matches. You have to kind of hunt it out.
Yeah.
And where we live, I don't know if it's like this all over the country, but there are just so many different schools. There's the public schools and different communities.
Okay.
Those schools range a lot, and then there's a long history of private schools in New England, and so there are many private schools.
Yeah.
They're all quite different. So we've tried everything.
Yeah. Yeah. Now, with the
Right.
schools that you've tried, do you feel like people are open to change? Because I felt like nobody wants to change, even in the private schools. My child goes to a private school, and when I present something, they're very polite. They'll say, "Oh, this is great, blah blah blah. We'll get back to you," and then nobody gets back to me. It's happened over and over again. I just don't think they want to change. They're just comfortable being who they are and doing what they've
Yeah.
been doing.
I I would say we've found the same thing. That like a particular school will have like a kind of like a product they're bringing to market. They've got they're also generally very conservative.
Yeah.
Um, Another thing that we've sorry, just to finish that thought, I would say like as we've explored, we have found matches.
Okay.
I had to like look around a lot, and we have our kids have like just very different needs between the three of them.
Mm.
Um, but we have very luckily been able to find, and it was not straightforward. It took us like a couple of years to figure
Okay.
it
Yeah.
out. But we have been able to find schools that have the right sort of like emphasis for each kid. So like
Okay.
our oldest and shortly our youngest are going to a school that's like got a really strong hands-on STEM program that includes
Okay.
like a robotics class and team and stuff like that. And for
Yeah.
them, that's like a great way for them to learn. And then our middle son just finished the middle school. That's like very high emphasis on writing.
Okay.
That
Okay.
was that was really great for him. We are similar. Like it's not that innovation's like unwanted, but we've just found that all of them are very reticent to change. That's I think almost
Yeah.
unique.
Yeah. And isn't that interesting? It seems like, people that don't want to change, are they still evolving and learning? And if they're not evolving and learning themselves as individuals and then collectively as an institution, how are they qualified to teach? Like, why do I want my child learning from someone that perhaps has stopped learning?
It's a really interesting. I've never thought of the question in that form. It's a very good way to form.
you know? um,
Well, I think there's the different incentives that teachers have.
yeah.
Right. Like I think there's career risk. Um, right. So they don't want to rock the boat. We kind of go with maybe not what's optimal, but what's no one's what's going to get the least amount of complaints. It's
Right.
regret risk, right? Trying to minimize regret risk. Um,
Yeah.
yeah. So, but anyway, I think that's a good segue to speaking of career risk. I know it's just the four of us. I did kind of plan some cool things that I've been thinking about while reading this book, and I definitely want to show you guys.
Okay.
All right, so I'll start off with a quote. I'm glad you're not the Stegosaurus who didn't know the meteor was coming, but even if the smartest Stegosaurus had a PhD in astropaleontology from Stegosaurus state, what would he be able to do about the meteor?
Can I ask something? Did you guys already go like over like a summary or like general thoughts from the book overall? But before I joined, maybe I missed it.
We have not. No, I did. You know, Foss did send that article which gave a summary of the.
Well, no, I was just my thoughts. No worries. I was just gonna give my thoughts. It was about.
Okay.
No, but it's good. Let's go ahead through the quote. I didn't mean to interrupt you. I'm sorry.
Okay. Yeah. I mean, we'll talk. We'll get everyone's thoughts. And I'll move through quickly. So about me, my name is Jonathan Ng. I live in Austin, Texas. Financial math. I have a financial math degree from Stanford. I worked at Jane Street, Platinum Grove. For a while, I was a sports market maker. Worked at World Quant. I'm currently at Apple, data scientist, and I also manage some money for a investment advisor. Okay, so same rules as last time. Be respectful. No politics, and have fun. All right, so who here has liked who here liked this book, and who wasn't a big fan? No, okay.
I would say it's interesting. Yeah, I can't say I liked it. It was interesting.
Okay, Benjamin, why didn't you like it?
So this book felt like I was trying to figure out all the references. Is this always how financial books are written? It felt like reading Billions, right? And like, have you ever seen the show Billions? And it's like every single there's like a reference and deep cuts. I'm like, what are these people talking about? So
okay,
that was a struggle for me. Maybe it's like I don't know. If that's a thing. Finance.
Yeah.
Book.
I mean, there's definitely like a lot of inside jokes in this book, right? And I think if you're familiar with the lingo and the type of talk that people have, I mean, I didn't know everything. I definitely used a lot of ChatGPT to sort of get some insights.
But I would say that last chapter with Michael Herman was mind-blowingly. That was really good.
Okay.
I enjoyed that.
Cool. So who here has learned something from the book?
I guess what I learned was, all of these people that come to pitch, they all sound the same to these investors, and I think the people doing the pitching are not aware because they have one data point. The investor has thousands, perhaps.
Yeah. Cool. All right. So let's play a game. So look, let me go back and I think similar to the last book, reading this book and trying to prepare for this book club, I thought about like, so what are the major themes? What can I get out of it? Like sort of what are the mental models presented in this book? Like where is there irrationality? And okay, so let's play a game. And I'm going to. I created this. Okay, this is Jupyter Notebook, obviously, and I kind of created like the simulation. All right, so this is the way the game's going to work. There are 9 managers, and they all kind of have a different beta with the market. They have some idiosyncratic returns, and I'm going to show the returns for 10 years, and you guys are you guys are CIOs of endowment. You got to decide, and I'll cut and paste this code so everybody can take a look at it. But you guys decide, like, who do you want to invest in? All right, and the first one we'll just it'll be practice.
Can I just interrupt and say this is awesome? I love this part already.
Yeah.
All right, so these are the returns. So this is a 10 years returns for 9 managers plus the index. One of which is SPX. The average returns for SPX is 3% with a volatility of 14%. And then you have these different managers. Some have done well. This manager C has done very poorly. It dropped 8% per, on average per year. Okay, so we'll just go around and you're in charge of an endowment. Who are you investing with? Samir, I'll start with you. Who do you like?
Okay, so I have some questions here. So when you say volatility, right? We're talking about the volatility of each of the managers' strategies.
Yes, yeah. If you just take a look at these are prices. So okay, everyone starts at $100.
Yeah.
If you take the returns and you just take the standard deviation of the returns, that's basically what this is.
Yeah. Yeah. Okay.
Yeah.
So I would say it sounds like manager one
Okay, so
has.
there's DE. Okay, so this is D, manager D.
Oh, it says E. Okay. Yeah. So that's a DEI. So I looks to be mimicking the index, or following the index
Okay.
fairly well, doing better than the index.
Yeah.
So I guess, and the vol is actually lower than the index, and the performance is higher than the index.
Okay.
So I
All right.
suppose I'm going with manager I.
You're going with manager. Okay. George, Benjamin, how about you?
So I'm thinking, wait, do we have to choose a manager or can we go with the SPY? Like,
Okay, yeah, you can go with SPY.
all right, I'm going with SPY.
All right, well, you know what? Okay, so like, I guess the whole point of the book is that like,
Yes.
if you go with SPY, then you're automatically just not as,
Okay, fair. Okay, so I think Samir had it with the manager I. It looks like it.
Okay.
I guess my question though, can you give me some parameters around so you said we're an endowment, so at least from the book I'm trying to figure out they want low vol consistent return. That's the premise. Is that what we're doing?
Okay, so yeah. So for an endowment you want lower vol. But let's say you can do cash and plus one of these managers. So let's not worry about the volatility of these particular managers.
Okay, yeah. So I'm going with Samir. Manager I.
Manager I. Okay, boss. How about you? Who do you like?
So I was just looking at the vol. I was kind of wondering if these all have the same leverage on, or if there's differences there. But just to keep things interesting, I think I'm gonna say E, because as I look back, they haven't had a drawdown in since their third year there.
Okay. All right.
Interesting.
Okay.
So.
All right, manager E, and I'll go with manager G because they have the strongest performance. And then now we'll see what happens for the next 5 years. All right, so actually the S&P is down a percent. Okay, so we got I and E. Okay, D is down 3%. Sorry, Foss. Oh, sorry, me. Okay, that sucks. Let me decrease this. So E is what Foss ended up choosing, up 6%, and then I is down a percent.
Oh,
so you guys are getting fired.
Is this a random generator? I feel like someone's.
Okay.
Simulation.
What's that?
It's rigged.
Yeah.
Okay, so these are the returns, and then what I did was I also just simulated this for 1,000 years, just so you can get a sense of like the overall statistics for them, and these are the returns. So D is actually the strongest. Who said D? Okay, I chose D. Okay, good for me. Has the highest returns, 8%. Just happens the past 5 years were bad. Okay, not bad, better than the S&P 500. So you guys win. And let's see, Foss, he picked manager E, and underperformed the S&P 500. So
interesting.
okay, so yeah, so I mean, we could play this. You guys want to play this again, or do you? Well, let's do it one more time. Okay.
Yeah, let's do it one more time. Yeah.
Do it one more time. Okay.
So tell us how you picked D. Like, how did you decide to pick D?
Okay, no, I'm not picking. No, I just picked D because no one else picked D and has the highest return. I'm not saying I have insight. The whole point of this exercise is basically you just don't have enough information. That's the whole point. Like there's just too much noise, and but yeah, let's go through this again. Hold on, let me clear this.
And are you saying we're ignoring volatility?
Yeah, let's just look at. Okay, it's a good question. I guess what we should really look at is Sharp, right?
Fortino? What is it?
I'll let you guys decide. What you guys want to choose. In terms of what do you want to make your priorities. Okay, so here's another one. Okay, S&P is up 5%. Everybody else is down except for manager I. Yeah, I do also want to mention that like I chose 9 managers, but realistically. endowments look at hundreds or thousands of different, right? And that makes it even more, even worse, because then you just get the extremes, right? Just by pure luck.
Yeah.
Okay, so manager I guess everybody's gonna choose manager I. There's no way someone's gonna choose
I guess
someone lower, right?
are you gonna? So it looks like everybody's together though. Like, see, it looked right. So
Okay.
through what is it? B, C. It looks like everybody except two of them are all following the same trend.
Yeah.
Yeah.
Yep. Yep.
Is
They're
that
kind of
on? Is
hugging the
that by
S&P.
design or is that random?
Well, there's okay. So how much they hug the S&P 500 is a random number. It's a uniform random variable.
Okay.
Okay.
Yeah.
But then why doesn't it look random on the graph?
I mean, it could, some can just maybe, like 99% S&P and then like 1% just a little bit extra.
Yeah, this cohort
Oh,
has a lot of closet indexers.
Yeah. Yep. A lot of closeted
Don't
indexers.
rock the boat.
Who underperform too. I mean, so
Right. High cost
okay.
indexers.
So do we pick? Do we go ahead and pick which?
Yeah. Why don't we go ahead and pick?
Can I ask you another question? Should we assume this is like a certain kind of fund? Like, are we the alt managers and we're looking at hedge funds, or?
Yeah. Okay. Let's say this is for your PA. All right. Like this is for your own money. You can decide what what your risk tolerance is, and yeah.
Okay.
But you can't pick market returns. Although this look really good in this scenario.
So I'm gonna pick the guy with male or female, the person with the lowest vol, like the 8%
Okay.
vol, right?
Okay.
That's manager H, right? And even though it's underperforming over like 10 years, I suppose,
10 years,
right?
yeah.
I want to see what happens over 1,000 years. We're thinking over 1,000 years, maybe the lower vol like wins out.
Okay. All right. Benjamin.
F.
Okay. Mean reversion, right?
Yeah, exactly. Don't hold them down.
Yeah.
Or her.
Okay. Foss, how about you?
I'm gonna go with D, the one that's like really hugging the S&P. I want to see
Okay.
that.
Okay, so we got D, H, F, and I'm going to choose I. I like winners. I'm going to stick with the winner.
Okay.
And then let's go here. D, H, F, and I. Okay, D is up 2%. H is down 7%. Oh, I'm sorry, Samir.
Oh no.
I is up 2%. So it doesn't seem like anyone's a big winner here. Yeah. Everyone.
After how many years was this, John?
This is after 5 years.
Okay, 5 years. Okay.
Yeah. Yeah, and then D's up. Yeah, so like you're probably going to do as well as the market. Yeah, it seems like I beat the market a little bit here. You can look at this chart, and that's what I picked. Okay, awesome. So let's look at like the 1,000-year returns. Okay, actually, all of these are worse except for manager E, and no one picked that.
Oh, interesting. Yeah.
Okay, so the whole point of this is there's just so little information to look at returns. And to just sort of go by that, like you have like one down year, down 2 years, it means nothing. And okay, yeah, let's go back to. I have some slides on this too.
I guess if I can say one thing, right, on the numbers, there's only one fund lost money after 1,000 years, and everybody else made some money. Not a lot made some money, which is really interesting.
Yeah. I mean, but everyone underperformed the S&P 500 except for one. But yes, one actually did lose money overall. Okay, so here's question number one. As a CIO of an endowment, how would you allocate capital amidst the noise and prevailing efficient market hypothesis? So yeah, Benjamin wanted to go with the market. That's the obvious answer. But
well, yeah, I mean, I understand what this, and the CIO actually talks about it, right? Like basically he can't just go with the market because he has to have a reason to be there, right?
Yeah. He needs to justify his salary.
Yeah.
I don't know. I don't have a good answer, to be honest. I think there's a lot of gambling going on. I don't
Yeah.
think anybody really knows, but
Yeah.
people pretend like they know.
Yeah. Yeah.
I really enjoyed so like I said, the conversation with Michael Herman and how he's pretty much just like I just focus and try to but I guess I would if I were him, I probably if I were the CIO after having that conversation with Michael Herman, right? That's the name.
Yeah, I think so. Yeah.
Yeah, it's I don't know. I think he would have probably just given the money to that guy.
Okay. Foss, any thoughts?
I feel like I'm so anchored to my own experience with all this, but I
Yeah.
feel like looking for lower correlation between the managers, looking for lower correlation to the markets, and probably spreading the book around, right? Like having a diversified pool of managers.
Mm-hmm.
The other example with this I always think of is Millennium, and it's not the same problem because their relationship with the manager is different, but just basically running like an evolutionary process, cutting
Right.
pretty aggressively and pretty quickly.
You're right. Yeah. Okay. So here are some thoughts that I came up with. Uh, and I'm borrowing a lot of concepts from like value investing. So number one's like circle of competence. Yes, you could like interview with a bunch of managers, like special situations in Asia, but if you don't really know how to evaluate that, it's pretty, you're pretty much at a huge disadvantage. So, and to me, I'd rather, stick with somebody and then knowing like the ins and outs of what that person's doing. So that's one thing. Two is, Charlie Munger always talks about like whenever you have a problem like this, like you invert the problem, and instead of focusing on what you should do, you should focus on like what you should not do. Okay. So what is that? What should you not do? You want to avoid mistakes. Look for red flags. Um, minimize regret risk. Um, I think that also means setting like clear expectations with the board. I think that's very important. In many ways, a manager is also a psychiatrist, right? They just have to, like, going back to that example, the game that we just played, like, if you have a manager and you think they're good and they happen to not be good for 5 years, but just because random luck, you have to, and you have the board, upset with you and hounding, like, oh, why do we have money with them? You're gonna have to make sure there's plenty of communication and let them know like why you think this is just noise. But it's tough, absolutely.
Hey Foss, how did you guys do it with Quantopian? Didn't you guys basically invest like people's money
Yep.
into strategies?
Yeah, and we both raised money from LPs, and then we allocated to strategies. And our approach was like very quantitative for the evaluation of the strategies. So we actually collected the code of the strategies and then ran them in sim, ran them against live data, and we looked for sort of the factors I was talking about. We wanted things that were good Sharpe ratio, meaning like for us that meant between like 0.3, 0.4, and maybe as high as like 0.7. And then to get something interesting, we tried to find 10 to 20 strategies like that also had low correlation to one another, and end up with a decent Sharpe ratio. That was the idea anyway. And in talking to LPs, I would say like the most sophisticated of them did a lot of analysis of our returns and our process, and gave us feedback about things like, like one had an internal factor model that they used for risk, and they gave us feedback about the factors that were of their pool of factors that they measured, they told us like what they thought were driving our returns, and then they tried to square that with the way that we were developing our portfolio, which I thought was pretty clever. So yeah, so for us it was almost 100% quantitative, and then I don't know. I guess I like quantitative management, so the allocators that were also quantitative, I was kind of impressed with.
Interesting. John, go back to your first point, right? You said circle of competence.
Yeah.
Tell us a bit more about that. What does that mean exactly?
Okay, like for example, I think certain things that I feel like have more expertise in, and those that have been like I feel like I can evaluate investors in that realm, whereas something like like merger arbitrage
Okay.
or what's that called, like macro funds, stuff like that, like which I have no idea. All I can really look at are like returns, right? And read their pamphlets or whatnot.
Yeah.
But it'd be so difficult for me to make an evaluation. So I think, I mean, it's tough. If as an endowment, you don't want to, you want to be diversified. You want to minimize career risk. That means hugging the index at some level, right? You just kind of want to do a little bit better than the index. So yeah, it's not an easy job, for sure. A lot of it, there's a huge luck component. You can choose the best managers, right? I mean, and then just happen to have a bad 5 years, and then you're out of a job. So it's, I've been thinking about this a lot. And like it's called like and I have some slides on it. But anyway, just to give you a sneak peek, it's like this illusion of control. It's like you think that you do all this research, you read about all these things, and then Mr. Market comes in and rolls the dice on you, and then you get screwed. You're like, what the hell? So, and I think there's so much in this book about how people like they try to do all this research, but ultimately it's such a minor part of what's really going to drive the returns.
But didn't Michael in the book? Doesn't Michael Herman kind of prove the opposite? That enough like work will make you $11 billion?
Okay. So it's just a character in a book, right? We don't know, like we don't quite know like what his strategy is. And yeah, I think there are certain things that are like Rentec or whatever, right? We talked about last book club. Like when you have like this really high sharps, like like 5+ sharps, then it's like then luck plays less of a role. But if you're talking about like a sharp of 1 or a sharp of 2, like there's a lot of noise in that.
Okay, fair point.
So yeah, I think so. Some ideas that I came up with are ask some of these investors to talk shit about the investors that you're interviewing with. Like see what their take is, right? I think that might be interesting. There's also this problem with money managers where like you give them some money, they do well, they get big, and they don't need your money anymore because they can just make returns off their own money, and they don't need you anymore. So basically, you're doing all this interview process, and you get like maybe 1 or 2 good years of returns, whereas the managers that aren't very good, who do want your money and will keep on continue to manage your money, by definition, they don't do well. So I think Foss mentioned the millennium. How they do have skin in the game. They have an ownership of those. Not only are they investors, but they also have ownership in the investment companies themselves. So I think that that removes a lot of the agency problem. Let's see what else. I think one thing is like sort of avoiding competition, like staying away from things that are heavily just like too many people in. Okay, so I talked about like this illusion of control and just gathering this information that might not be helpful. I like this quote a lot. You have the grillers who want to know every portfolio company's margins, market share, to the second decimal place, CEO's age, the color of his wife's pubic hair. They scribble into notebooks or type constantly into iPads like they're going to have to show notes at the final exam. The weird thing is that some guys bring in hardcover notebooks with silk bookmarks, and then a woman will bring in some shitty spiral notebook that she must have swiped from her kids. So yeah, so like you're gonna have people that are just like do a lot of do all the analysis, a lot of details, and are they going to have better returns than the people who kind of like throw a dart? Yeah, I don't know. It's tough. So I'm sure some of you guys are familiar with this. What's it called? It's the
Yeah, I forget the name. I've seen it before. I forget the name of the cartoon.
yeah. It's called something like. Hold on. What is it called? Like the lamp, I think it's called lamppost fallacy, where like you're only collecting data from places where you have visibility in, and it could be like not the best place to look. Okay, so all right, so here comes question 2. In light of limited information, selection bias, and the role of luck in investment outcomes, how can you distinguish between alpha, noise, and marketing? I talked about earlier about the illusion of control, and just like, and then obviously like just collecting information where it's available, but not that be important. You think about like the interview process, right? You have people that like the manhole cover interview that they talk about. Like, is it really correlated to how well you are, how well you perform at a company? I would say it's very little. And I try to really think of like a good example of like how we collect all this information and because it's all that we have, but it's not really helpful. So the example that I came up with was like using a Tinder profile to see if someone's like marriage material, right? Like you're single, you're trying to find a wife, someone trying to start a family with. All you have is their Tinder profile, and you like. I guess you could like go through every single word and preference and their favorite movies and stuff like that and figure out whether you're compatible or not. But like really, that has like such low correlation to what you're really looking for that it's essentially like a stab in the dark. So yeah. Okay, so yeah, so how can we distinguish between alpha, noise, and marketing? Benjamin, I'm gonna call on you. Any thoughts on that?
I don't know. I think it's really hard, and I I'll just look at my investing career. It's not in like stock trading. It's more in the real estate space. And if I'm looking
Okay.
back, I think it's just a lot of luck, right? It's a lot of just me buying in it when rates were low and happening to buy in the right place. And yeah, I think it's probably role of luck is like 80%, like something really high.
I mean, like I mentioned earlier about inversion and like spending a lot of your time just avoiding mistakes.
Yeah.
And that seems to be the case also with real estate too. Like obviously there are things that like they're clear red flags, and if you just avoid that, then you're gonna be doing better than the
That's
average.
actually a really
By
good point. I
definition.
like that. How much of it is avoiding mistakes versus trying to make money? That's good.
Yeah, yeah, yeah. Because if you take the S&P 500 and then remove, I don't know, the worst 25%, you're in pretty good shape, right? You're by definition beating the market.
I think what comes to mind, right, with this question is kind of what is the time horizon over which you want to answer this question? Like, you meet somebody, they pitch you, and they show you some results. I don't think you can tell, like what's alpha, noise, or marketing. Kind of back to your analogy, right? Tinder analogy. You meet someone, maybe there are no flags, they look promising, don't really know. But then over time, as you go
Yeah,
through life, you go through what life throws at you, and you see how you do as a team, and then you're sort of updating what is the term? Updating your priors, I suppose, you know, and then you have, as time goes on, you have more confidence about whether or not that's the right person. So I wonder if something like that can, if that transfers, the analogy transfers to investing. I want to say maybe it does, but I'm not, I guess I'd struggle to explain how. I don't know how you would translate that to being the the CIO of an endowment and making investing decisions.
Yeah, I think it's really hard to be to have like 20 managers and on top of all of them and really seeing like what they're up to, right?
Mm.
That's really difficult. Like I think if it was my own money, for example, I would just focus on like 2 or 3 managers that I really trust. Try to think more like long term, because they're going to be drawdowns, and by that and sticking with a manager during a drawdown is important if they're good, right? Like because usually that's during drawdowns, that's when they have the best returns afterwards. Yeah, I think it is tough. I would probably like not be that diversified. Ask a lot of tough questions, like focus on their process, rather than like the results.
Mm.
So Foss, I have a question for you.
Okay.
So I remember watching this video a while ago about Bayes Alpha.
Yeah.
And like it seems like you guys were going down that route, and then you guys kind of avoided that route. But from the video that I was watching, it seemed like it had a lot of promise. I was wondering
Yep.
if maybe you can share some of your thoughts on that.
Yeah, I actually think, in retrospect, actually, I wish we had pursued that more aggressively than we did.
Okay.
And I guess like the thing that we found that was the most sort of like predictive factor, based on Bayes, was taking as a prior the performance of other strategies by that same person. So if it was a person that had produced alpha, they were more likely to produce alpha in the future,
Okay.
which I thought was really interesting, because essentially saying like there is such a thing as like investment talent,
Okay.
and that if you find a person with it, then that's who to bet on. So
I see.
track record is pretty important. And you said something earlier that I think is a great way of phrasing the question. I was trying to think of like how I would answer it. I don't have an answer, but um, you said like like what factor, what would you look at that isn't the returns that would be predictive of the returns? Like what's the sort of indicative factors for the manager? So I guess like one example from our work with Bayes analysis would be that external track record or prior track record is very
Right.
important.
Right. So like if somebody had like several funds, for example, and just
Yeah.
incorporate all that information.
Yep.
Yeah,
And,
that makes sense.
and as I think about it, that's kind of what's been happening in the industry. There's a lot of consolidation, and then launches today are usually like mega launch, not usually, but they're more and more mega launches. People are going out with billions of dollars in assets on day one, because they're coming from either another firm that's super successful, or
Right.
they themselves have a great track record.
Right. Okay. So I guess So I guess not only their track record, but their previous company's track record, taking all that into account.
Yeah. I
Right.
do. I think the other thing that I was thinking about when you were saying like the circle of competence, that actually reminds me of some of like the allocators that I thought were very sophisticated, where they were just very capable of evaluating the process and the strategy, and getting deeper into sort of how things worked and why, and how we were running our operation,
Okay.
and not just like the returns. were definitely important. And the sharp, the realized sharp, the realized returns, things like that were all very important. But they also like went really deep on every aspect of our process.
Right.
I'm curious about, John, your thoughts and everybody else's thoughts as well on kind of intelligence versus like insight or wisdom, right? There are a lot of smart people, but I guess smart to me is like a local maximum, or maxima is it called, and intelligent or wisdom would be like global. Like Oppenheimer building the bomb was very smart, but was it wise? That's debatable. Does that sort of line of thinking, would that lend itself to better manager selection?
I'm sorry, you're saying that people that are overall like intelligent, or
Like
just like
making a distinction between intelligence and wisdom. Like, when you think about companies and hiring and careers, there's a lot of focus on intelligence, but I never hear anybody say, find us somebody that's really wise.
okay, right, yeah,
Right.
yeah,
And there's a distinction there, right?
yeah, yeah.
So,
Like a lot of like STEM people, techie people are just not very good investors.
so Samir, one of these allocators I thought was great, the same one who did the factor analysis, the lead investor there, said to me, there's a difference between clever and smart, which is kind of similar to what you're saying. And he wanted to explain that he thought clever could be dangerous because it's kind of alluring. But it's almost like, so making like weird quant analogies, but it's almost like clever is overfit and a little bit brittle.
Yeah.
Okay, cool. Let's move on. We have 9 more minutes. Okay, so let me just see. Let's just skip. Oh yeah. Oh yeah. So yeah, this comic I found, again, comes back to like the illusion of control. I mean, illusion of illusion of control. So you wanted some water, huh? Well, I got a big can of here. I got a big can of it here. It's up to me to decide if you get water or not. I control your fate. Your very lives are in my hands. Without me, you're as good as dead. Without me, you don't. And then it starts raining.
Right.
Okay, so question 3, and I only have 4 questions in total, so this is the second to last question. How does the illusion of control and the impersonal nature of markets impact the investment process? What strategies can help avoid these biases? So okay, yeah, so the impersonal nature of markets. So what does that mean? So when you have like a really naive trader say something, oh yeah, I bought it at this price, where should I sell it at? And people say, oh yeah, the market doesn't care about where you bought it, right? It should have no bearing. Like a time to sell it should it be kind of be independent of where you bought it, or how much money you're making, or whether you lost money or not. And I definitely found, like, in this book, he was like very focused on getting his whatever, like $300 million per year to help fund the school. But the market doesn't care, and you shouldn't really like make investment decisions based on what your needs are, right? The investment decisions should be based on the opportunity that's out there, not based on what your needs are. So what strategies can sort of help avoid these biases?
So I would say, I'm not sure of the strategies. I think the impersonal nature of markets also, like for CIO of the endowment, he was investing other people's money, right? Donors gave that money and then he was investing. So how do you take on the responsibility, or how do you make sure that you still care even though you don't actually necessarily have skin in the game?
Okay.
So I guess, like, Foss, for you, what when you guys were investing LP's money, what did you do to make sure you guys, kept skin in the game, or kept it kind of more personal than?
Yeah. Well, one really direct way is to have money in the strategy, and that's like a very important question for allocators, right? They want to know that the managers have money in the fund, and
Yeah.
so that's definitely like actual skin in the game is really important. And then the structuring of the incentives, fee wise, is also important. So we did a lot with that because we were trying to share the incentive with the authors of the strategies that we're searching and selecting. So those are like I don't think there's anything like especially insightful what I'm saying. Those are like the two ways that I think the industry uses.
No, I mean, that makes sense. And I think that's probably why the reason it's still prevailing is because it's effective, right? Like people have been doing that before.
Yeah, it's especially like just having money in the fund. I think, and they like to know that it's like a significant amount. So it's like really meaningful. They definitely look for that.
The illusion of control part of it. And I'm trying to recall from the book. I kind of heard bits and pieces of the book here and there in random order, I admit. Was that a big focus of the book, the illusion of control? And would you say that most people have that illusion of control? Like, wouldn't there be a subset of people that are aware that there is no control?
So I don't think it was like a explicit theme in the book, but it's something definitely that I kind of drew out from it.
Yeah.
Like going through this whole process of interviewing people and figuring, asking them questions, and in some ways he's kind of like given up, right? He's kind of aware of how silly all of it is, right? How futile it all is.
Yeah.
When it just comes down to a lot of it, just other factors that are coming to play.
The CIO.
I love what you said earlier about the focus on the outcome and like the goal for like the kind of like revenue goal, basically.
Yeah.
And just in anything that's dangerous, right?
Yeah.
Well, if you're focused on the outcome and not on the inputs.
Yes.
Any kind of business.
Yeah.
That like really struck a chord when you said that.
Yeah. You never want to risk money that you can't afford to lose, because then you're forced to sell and close out positions and all those other things, and that can be really terrible.
Yeah, and actually, it clicked for me going back to like the first question of like, what would you look at? You could start at sort of like a higher granularity and think about like, where's the opportunity set? Is it in an asset class? Is it a certain kind of strategy? The allocators, the management selection is really important, but I would guess that like the style factor and the asset class, the markets that they're investing in matter a huge amount, right? There's probably years where everything from like venture to crypto to alts to equities, certain industries, stuff like that. So I don't know if they do this, but I wonder if endowments spend a lot of time just thinking about that. Like, what's the allocation of their assets based on the opportunity set for these different types of strategies?
I think the CIO called him like he had a set of heuristics, right, that he used for investment. I think that's where his like illusion of control was. That's what he named it anyway.
Right. Yeah. You hear about people that put money in their 401k. They don't stare at it, and then like 30 years later, they're like, "Oh my God, I have all this money," and like, right? I call it like a time machine, right? Where you just like are totally blind and ignorant to it, and so that you kind of like ignore all the volatility, ignore all the drawdowns, don't make any dumb mistakes, and then bam, like 30 years later, compound returns. And I think that's also an important part of the investment process, where you just kind of distract yourself. Staring at your P&L every day is extremely dangerous, because nothing good can come of it, especially with loss aversion. So I think like distracting yourself, not focusing on the results, and maybe even distracting like the board of the endowment as well. I think those are like some good strategies out there. When you have this annual requirement every year, that's just terrible, and not a happy life to live. for sure.
So do you mind me asking if you can expand on the not focusing on the results part? That if you're not focusing on the results, what are you focusing on?
Okay. Yeah. So yeah, let me share like my own investing
No.
process. Of course, I look at my returns every day. I try not to focus on it. I try to look for like bugs in my program, big mistakes, bad data feeds, those type of things. But I really try not to like calculate my returns for the end of the. Okay, so yes, I am aware of my returns at the end of the day. It's hard to ignore that. But like my year-to-date number, for example, like I will purposely not calculate that because I don't want to get in that space where like it affects me. And again, there's just so much noise out there. Um, I like to use like poker analogies a lot. You hear about the people that are on tilt. They go through, great poker players. They played it well. They go through a bad streak, and they have to be extremely careful not to let that affect the way they play. Right? They can't play like more aggressive or more conservative. And so, like I think like the games that they play with themselves are very appropriate for investors. Yeah, so yeah, don't look at your positions, distracting yourself. Yeah, I think that's important. Okay, so we are out of time. Last question I had was about let's say you are an asset manager. How do you convince the CIO that you have an edge? Market flooded with unique pitches and strategies. That's also a tough one. I thought about this question. I think you got to go. You got to sit through a lot of those meetings, right, and see like what works and what doesn't work. I think also like some things might resonate differently with different endowments, and so learning what they kind of like are looking for. Not every endowment's the same. Not every endowment CIO is the same. So just trying to get as much like intel as possible and sort of catered your presentation to him or her. Anyway, okay, so that's it. So this is my suggestion for the next book. It's called The Scout Mindset. Here's a quote from, here's a review. In The Scout Mindset, Gallup shows what makes scouts better at getting things right isn't that they're smarter or more knowledgeable than everyone else. It's a handful of emotional skills, habits, and ways of looking at the world, which anyone can learn. With fascinating examples ranging from how to survive being stranded in the middle of the ocean, to how Jeff Bezos avoids overconfidence, to how super forecasters outperform CIA operatives, to Reddit threads and modern partisan politics. Gallup explores why our brains deceive us and what we can do to change the way we think.
Fascinating. Yeah.
I'm wondering
Cool.
how you're going to write a simulation for this one.
Cool. I'll share the code.
Sick. Jonathan, can I ask one more question?
Sure, yeah.
I'm embarrassed I haven't asked you this before, but like, what is your investment strategy for your fund? Like, what kind of strategy? Is it quant? Is it value? Like, how do you invest?
It's a good question. So yeah, so
And sorry if it's proprietary. I didn't mean
yeah.
to put you in the spot. You don't.
So I'm a strong believer to like of going where there's like no competition, and
Okay.
so I try to find pockets where like not many people know about, or not many skilled people are there.
Okay.
So that's one thing. We talked about this earlier about how data is extremely important. It's all about having good data. So I spend a lot of time just getting different data that I think nobody else is looking at.
How do you gauge that? Like, how do you look at data and think, okay, this is something that is going to be rare?
That's a good question. So I trade a lot of small cap and micro cap stocks, and I can see the trading volume for it.
Okay.
And
Yep.
so so that's how I can tell.
Got it. That's super interesting. I feel like it'd be fun to somehow set up like a game version of actually evaluating a manager, pretending that we're alligators and asking a bunch of questions, see if we could figure out what we would do.
Yeah, actually, I thought about this, something similar. Like you go back in time, like 20 years ago.
Yeah.
Okay.
Yeah.
You get the marketing information from a bunch of managers. Okay. And you anonymize it or whatever, and everyone like says, "Oh yeah, I think this person's good. I think that person's good," and then we can see the results, and then we can see like how good we are at evaluating.
That would actually be super fun.
And in fact, what we could do is we could like feed that into ChatGPT, so we can actually have a conversation with the manager, right?
Yeah.
So you have a conversation with the manager, and then you can we'll play the same game.
I actually kind of want to do that now.
Cool. All right. Thanks, everyone.
Hey, that was so fun. Thank you so much.
Yeah, thank you. That was fun.
Good night, guys. Thanks.
Night.
Bye.